Good morning, everyone. Happy Friday. Thank you so much for spending a little time with us today here at Asset Exchange Company. We're going to hopefully make your time worthwhile and give you some information that can help you grow your business and build and protect your wealth. We have a few people on already, and if you'll notice on the right-hand side of your screen, there's a chat window. If you can hear me, can some people just write a little something in there so that I know everybody has audio okay? That'll help me out a little bit. Let's see, I'm not seeing anyone yet. Do we have audio? Can everyone hear me? If you can hear me, please write something in the chat window so that I can verify I have the audio to everyone. Okay, great. I hear someone now, or I see someone's message now. Okay, great. Thank you, Salim. All right. As I mentioned, there is a questions panel on the right side of your screen. As we go along, you can write questions in there, and I'll do my best to answer them. If I don't, it may be because I'm going to answer it later on in the presentation. Or if you have something that's really detailed, I may just contact you privately afterwards so we can discuss your situation in detail. Right before we get started, if you can take a moment and like us on Facebook, this is partly how we keep our webinars and workshops free, is we use a lot of social media and email messaging to our people and our contacts. So that would help us out a lot. My name is Debbie Skora. I am with Asset Exchange Company, which is a 1031 exchange qualified intermediary. We're located in California, and San Francisco is where our corporate headquarters is. But I am based in Los Angeles and handle the entire Los Angeles area. So we also can do exchanges nationwide. But if you're looking for somebody local who you can contact and talk to and who knows the LA market and that sort of thing, that would be me. I also previously sold real estate. I worked with investors. That was kind of my niche and my passion at the time. I loved doing commercial and resimercial properties and working with investors, and I'm an investor myself. So 1031 exchange is something I've been around for a long time and really enjoy sharing with other people because it's such a great tool for the investor. Our company is called Asset Exchange Company. We've been in business for 11 years, almost 12 now, and we're one of the largest independent exchange accommodators in the U.S. And if you're wondering what exactly that means, a lot of exchange accommodators are either tied to one of the large title companies, or they may be very mom and pop and just be maybe one person sitting in an escrow office who does whatever comes across the desk. And we're kind of in the middle. We're a bigger company. We have marketing staff. We have several exchange officers. We have a tax attorney on staff full-time who's one of our partners, and he oversees all of our exchanges. Through him, we're a member of the California Board of Accountancy and the California State Bar, and we are bonded and insured. And you may wonder why all of that is important. Well, first of all, we're going to do a little bit of housekeeping and let you know that this is not a basic 1031 exchange class. So if this is your first exposure to 1031 exchanges and something just doesn't make sense to you, go ahead and ask a question because there's no silly questions, and I would be happy to just take a step back and answer anything that is become an obstacle to your understanding what we're talking about. And it's so important that you have the correct information. As you'll see when we go through this, because there are lots of problems and pitfalls that can derail your exchange. And you may not even find out about them until much later when you're paying your taxes. And at that point, it's too late to do anything about it. So that's why it's so important who you choose for your qualified intermediary. You want to choose someone who has the expertise, has the experience, like Asset Exchange Company, and we have done 25,000 successful exchanges in the 11 years we've been in business. We're also bonded and insured, and that means your money is insured against theft and also against errors and omissions which may occur on our part. We also provide audit support. So several years later, if you wind up getting audited for the year in which you did your exchange, you're going to find us still around and still available to help you out. And we will provide everything that you need to show the auditor that your exchange was allowable and valid according to the Internal Revenue Code. And one of the things that we're getting a lot of questions about now is tax reform. We have a couple of tax proposals out there, one from the House and one from the Senate, and those are going to be merged into something that is a single piece of legislation that will then be passed by the president and become our new tax law. And we've had little nuggets of information out about both plans. The House released their plan in November, and the Senate released some details about theirs a little later. And the long story short is, even though there's a lot of things that are changing, most of the things about 1031 exchanges for real estate will remain the same. Now, currently, you can exchange a lot of other things. You can exchange personal property, you can exchange furniture, fixtures, and equipment, in certain commercial sales, like for instance, if you have a restaurant and you're going to also sell the kitchen equipment along with it, or a hotel and you have all of the furnishings inside, those things currently can be exchanged, but they will no longer be exchangeable under either of the new tax plans. So even after they're merged, there won't probably be any changes to that. But as far as real estate, investment real estate is concerned, 1031 exchange has been preserved under both plans, so that's really good news for us. If you have any questions about tax reform or any of the other real estate provisions that are included in the plan, go ahead and message me, and we can have lengthier discussions about that. And again, here at the bottom, please, please, please ask questions if they come up. Not only does it get your question answered, but it helps other people who probably are thinking of that question too. If you have that question, you're probably not the only one. So let's get going here and into the presentation. Problems and pitfalls in 1031 exchange. These are a number of topics that we come in contact with on a daily basis, and these are all things that if they're not properly prepared for can derail your exchange and mean that you wind up paying taxes, which nobody wants. And so we're going to go through them one by one as we go along with the presentation and try to explain how they happen and how you can avoid them. Tax fraud, property that's not qualified, waiting too long to start your exchange or find your replacement property, doing an exchange with a related party, so someone in your family, your sister, your parents, your children, can be a problem in an exchange. Having different taxpayers. A lot of times when people do an exchange, the actual taxpayer who's selling is not the same taxpayer who's buying, and that can be a problem because that's not an exchange. There's no exchange to be done if you have two different taxpayers. Boot. If you don't know what boot is any cash, it's anything that comes out of the sale that's taxable. So it doesn't go into the exchange, and it may be something that you're not even aware of and can create a taxable event even though you're doing a 1031 exchange. Seller financing. Carrying back a note on your sale in an exchange can, again, create a taxable event for the seller, and we'll talk about that. Vacation rentals, they are exchangeable, but if you don't do it the right way, again, it can be disallowed. Foreign sellers, Foreign sellers can do exchanges and defer all of their taxes on the sale of an investment property. But if they're not careful, they may have a large amount of that sales price withheld for a tax deposit. So we'll tell you how to avoid that. And hidden gain. We're going to go over a little bit how to properly calculate your gain and make sure that you're not missing any of it when you're trying to figure out how much you'll be paying in taxes if you don't do an exchange. So very simply, what is a 1031 exchange? And there's a couple of important pieces of language in this definition that you need to understand. Section 1031 is the actual number of the section in the Internal Revenue Code that describes the process by which you can sell an investment property and make a profit and buy another investment property and not have to pay taxes on the gain. This is a great tool for investors, and the savvy investor will use this as part of a greater strategy for investing over their lifetime that we call defer, defer, die. So you keep on pushing that gain forward into another property and another property and another property until finally that last property becomes part of your estate and it dies with you. No taxes are owed. So that's a really important thing to understand, and to kind of understand the big picture of that and how it works into your investment plan for your life and for your estate planning. Also, understand that this is a deferral of taxes. So this is not an exemption. The taxable gain that you have on the sale of your property isn't going away. It's just being deferred into the next property. And it gets deferred and deferred and deferred, as I mentioned before, until you die, and it finally goes away when the property is inherited by your estate. And the other really important things that you need to understand about this definition is that it's taxes on a capital gain. So you can't do a 1031 exchange to avoid paying taxes on ordinary business income. And this will come into play a little later in the conversation when we talk about the definition of capital gain and seasoning requirements on your property. And again, this is only available to people who are selling investment property and buying another investment property. So it doesn't involve primary residence. Seems like a really simple definition, a simple little one-line definition of a Section 1031 exchange, but there's a lot contained in there. And in order to really understand the purpose and the spirit, so to speak, of a 1031 exchange, it's important to understand the terms in this definition. Okay, our first pitfall was tax fraud, if you remember. So this is an example, and we use this in all of our workshops. It's the example of Cheryl Savage, who was a broker in Salinas in the Monterey Bay area. And she decided to do a 1031 exchange on the sale of a rental property. So she sold her rental, but she used the proceeds to purchase a single family residence that she then moved into herself. So basically she sold her rental and she purchased a primary residence for herself. And she knew that it needed to be a rental to qualify for exchange, so she took it a step further and she falsified her tax returns, which of course is tax fraud. And she went along, and a couple years later, she got that knock on the door from the IRS, and they audited her and looked at her tax returns and looked at her bank account and everything and said, you know, this is not an allowable 1031 exchange. And her first response was to plead ignorance and say, well, I didn't know about 1031 exchanges. It's a complicated process. Sorry. And they went to her website. As I mentioned, she's a broker in the state of California. And they went to her website, and on her business website, she mentioned that she knew about 1031 exchanges and could help her clients do them. So they said, you're representing here that you know about 1031 exchanges, and what you did is clearly not allowable and is clearly tax fraud. So she had to plead guilty, and she wound up spending 14 months in prison. and she paid over $120,000 in fines and restitution. So why do we always bring up this example? Well, we bring it up because we want people to realize that fudging on your 1031 exchange or trying to stretch the rules or bend the rules is not the smartest course of action. The IRS takes this very seriously. And also keep in mind that we live in California and we have one of the most aggressive taxing authorities in the United States in the Franchise Tax Board. They take it very seriously. In fact, the Franchise Tax Board is more aggressive about 1031 exchange than the IRS is. And that isn't to say that you can't do a 1031 exchange and not have to worry about audit. Not a lot of them actually get audited, but you have to make sure that if that does happen, that what you've done is allowable, that it's according to the Internal Revenue Code requirements. And that's partly what we at Asset Exchange Company can help make sure that you're doing. And also, again, providing you with that support when you do have a need to defend yourself in an audit. One of our next pitfalls, and this is a very common one, is that the properties of the exchange are not qualified. And this actually is what happened to Cheryl Savage. She bought a non-qualified property. She bought a primary residence, and that's what blew up her exchange. So these must be business or investment properties. This is the property that you're selling and also the property or properties that you're buying. And people say, well, what exactly does that mean? What's a business or investment property? Well, a good rule of thumb is that it produces income by holding. And this isn't true all the time, and it's not to say that anything that produces income by holding is exchangeable, but it most likely is exchangeable. So whether you're collecting rents or you're running a business on the property, anything that produces income by holding, also holding, say, a piece of raw land for the appreciation is also producing income by holding. And of course, the easiest way to do that is to show that you've been collecting rents. And that's by far probably the most common use for 1031 exchange, is to exchange a property that has either been collecting rents as a residential rental or a commercial or a business rental. You could also have a space that you're using as a farm or a ranch. When you have land that you're running a business on, that qualifies as well. Now, there's another situation we get a lot of questions about. And remember, going back to that definition of a 1031 exchange, where it asked, or where it mentions capital gain. In order for an asset, in order for the proceeds of the sale of an asset to be considered a capital gain, you must have held that asset for at least 366 days. And this is according to the Internal Revenue Code. So anything that you've held less time than that is not going to be considered a capital asset. And the income you make when you sell it is just ordinary business income. So this applies to flips and developments in particular. And you may be making a lot of money on them and want to defer it in a 1031 exchange and reinvest that in another business property. But if it's a flip or development, it's not considered a capital asset. It's considered inventory. Just like if you had a retail store and you bought raw material, you made it into something, and then you sold it for a profit. In this case, I'm talking about flips and developments. You produce the income when you sell. In fact, you probably don't want to, most flippers or developers don't want to hold the property any more than they have to, because every day they hold it costs them money. So in most cases, these are not going to be exchangeable. Now, if you're a little bit short on your seasoning requirement, this is something that may be a pitfall. People say, well, what exactly is the seasoning requirement? It's difficult to say. Unfortunately, the Internal Revenue Code is not specific. as I mentioned before, we know that the definition of a capital asset is one that's been held for at least 366 days. So it's pretty safe to say that you have to have it at least a year. We also know that we are in California, and the Franchise Tax Board, through our experience with audit case history and also different statements that they've made over the years, we know that the Franchise Tax Board is looking for 24 months. So what we have from that is a recommendation from our company, which does the majority of our business in California, that you hold your property for at least 2 years. And if you have a good solid 2-year hold for a property that's been in service as a business or investment property, you've been collecting rents, you've been depreciating it, doing all the things that you would do for a business or investment property, then you're pretty safe that you've met your seasoning requirement. If you're a little bit short on the 2 years, let's say you fall between that 1 and 2 year period, or even shorter than that, we always recommend that you talk to your CPA or tax advisor. Because think about it, in the year that you report your exchange, your CPA or tax advisor is going to have to sign that tax return. And it's a pretty frustrating thing if you do an exchange and then you go to file your taxes and your CPA says, you only held this property for 6 months, I can't sign off on your tax return. And then you're kind of up a creek without a paddle. So make sure you talk to whoever advises you or does your taxes and see what they recommend based on their experience. And they also know your greater financial situation and if there might be any mitigating circumstances, which sometimes there are. Now, we also hear a lot of tax advisors say that if you report income on 2 consecutive tax returns, then you're probably okay. So again, there's a lot of different opinions on this, and you just have to kind of take our recommendation, which is 24 months, especially if you're in California, and the IRS specification that something is a capital gain only after you've held it for at least 366 days, and kind of judge in there where you think you are. And we can help you with that as well, too. A big pitfall that people get into when they're trying to do an exchange is waiting too long to get it set up. Oftentimes, people will have their business or investment property for sale. They may even have it under contract with a buyer in an escrow, and they don't realize till the end how much capital gain they may have and what kind of tax liability they may be setting themselves up for. And so all of a sudden, they panic at the last minute and say, I need to do an exchange. And it may even be after they've closed escrow. So we have a scenario here where someone is selling their rental property and they open escrow, and they may have it in the listing that they're thinking of doing a 1031 exchange. It may even be in the purchase contract, and they may have told escrow and assume that escrow is going to take care of it. In fact, I talked to a guy on the phone yesterday who asked about a 1031 exchange, and I explained kind of the basics to him, and he said, oh, well, my escrow will do that. And I had to explain to him, no, they can't. It has to be a qualified intermediary for 1031 exchange, and your normal escrow officer doesn't do that. They will refer you to a qualified intermediary, but they don't do it themselves. So you have to make sure that you have this properly set up, and don't assume that your escrow is going to take care of it just because you specified it on your paperwork. So if you close escrow, let's say you close escrow on Friday, your deed's recorded and the funds are dispersed to your bank account, and you call us first thing Monday morning and say, I just closed escrow on my investment property, I want to do an exchange. Guess what? It's too late and you're going to owe taxes. You cannot have constructive receipt of the proceeds from the sale of your investment property. What that means is it can't become into your possession at all. So what we do is we set up the exchange account before you close escrow, and as soon as escrow closes, the funds are wired into the exchange account. You go forward with your exchange, finding your replacement property, making offers, getting into escrow on the replacement property, and then we transfer the funds into escrow for the replacement property. And hopefully none of it ever hits your bank account, because if it does, that will be taxable. So, and then at the end, of course, we disperse funds to all parties who are supposed to get the funds. Long story short on this one, you must open your exchange before escrow closes to avoid paying taxes. Otherwise, you will have a 1099 coming to you and a taxable event and a lot of taxes owed that you didn't count on. Related party transactions. As I mentioned before, this is when people in the same family are doing business together. And it's really, really common, and there's nothing wrong with it. But much in the case of a short sale, if there's any of you who were around doing short sales several years ago, when that seems like what every single transaction was, the IRS and the Franchise Tax Board want to see arm's length transactions. So even though there's nothing wrong with doing business with family members, of course, in the case of a 1031 exchange where you're trying to defer your tax liability, you don't want it to look like you're just redistributing assets within a family. There's a lot of tax liability that can go on with giving gifts and money within a family. For instance, let's say in this photo here, we have a father and a son the son owns a brewery or whatever, a business, and he wants to expand, and maybe the father has some money that he wants to gift to the son to help him with his business. Maybe he has $1 million, but he doesn't want to pay gift tax on it, and he doesn't want the son to have to pay income tax on it. So he says, hey, you know what, just sell me your property and I'll pay you the $1 million, and you can do a 1031 exchange and not pay taxes, and I cannot pay taxes, and we'll accomplish what we want to accomplish. Well, the IRS is wise to this sort of arrangement, and that's not the spirit or the intention of a 1031 exchange. So oddly enough, the IRS wants to be satisfied that tax avoidance was not why you did the 1031 exchange. Sounds a little counterintuitive, but that's the truth of the matter. And there's several ways that you can do a related party transaction and still have an allowable exchange. In most of the cases, both parties are going to have to be doing an exchange. So instead of dad, taking his money that he's got sitting around and gifting it to the son by buying his property, if dad's doing an exchange too, so let's say dad sold a property and then he's using the proceeds to buy the son's property, and then when the son sells his, he's going to buy another. So you're both doing exchanges. That's almost absolutely required if it's a related party transaction, because that tells the IRS you're really truly exchanging your real estate. You just happen to be doing it with a family member. Another case is when there is fractional interest in a property portfolio. Let's say if parents pass away and they leave 2 or 3 properties to their children, and they give them each a fractional interest in all of the properties. And afterwards, the kids say, well, this is ridiculous. I'd rather have property A and Susie have property B, so let's buy and sell from each other to clean up the title. That's also considered a valid exchange, again, if both parties are doing exchanges. And another thing that will validate your exchange is if the party that's not doing an exchange winds up having a big tax liability. In that case, they look at it and say, well, okay, you obviously weren't colluding with this, or you weren't doing a very good job of it, because you still wound up with a big tax bill. So that could be another thing that they would look at and say, okay, yeah, we'll allow the son's exchange. So a lot of mitigating circumstances you can do here to do a related party exchange. Probably the most important one is this first one here, that each of the parties does an exchange. So if you're doing a related party transaction and only one of you wants to do an exchange, be very careful, because it's a very risky exchange and is very likely to be disallowed. The different taxpayer pitfall. I mentioned this earlier when we were talking about the definition of a 1031 exchange. It allows a taxpayer to sell an investment property and buy another one and defer the taxes on the capital gain. Not two taxpayers, just one. So a single taxpayer does an exchange. So let's say that Joe and Jan own a property as husband and wife community property. See, they own a 4-unit apartment building and they own it together, husband and wife community property. And they file their depreciation and their rental income on their joint tax returns. Excuse me. But now Joe and Jan, unfortunately, are getting a divorce. And as part of the court order, they have to sell the property and split the proceeds. And Jan says, well, I don't want to pay taxes on this. I want to do an exchange and buy my own investment property. And that's great that she wants to do that. But Joe and Jan, husband and wife community property, filing all of the burdens and benefits on their joint tax return is not the same taxpayer as Jan. So a community property title on the sale property versus a sole and separate individual interest title on the purchase property, those are not the same taxpayer. You must have the same ownership. And another thing that's really important is that burdens and benefits. Aside from what the title says, there's also the question of who is reporting the income on their tax returns, who is taking the depreciation, who is writing off the expenses. So if they're doing it together jointly, then they're going to have to purchase the new property jointly. So that's one thing they can do if they don't have a problem with it, is they can go ahead and buy the replacement property jointly. And then after they season it, they can drop down into tenants in common and go their separate ways after the exchange. But obviously when someone's getting a divorce, a lot of times they don't want to do this. There's hurt feelings. People just want to go their separate ways. And we get questions about this all the time. It's unfortunate. And usually it just means that they can't do an exchange. Divorce is expensive, and this is one of the ways that it's expensive. It may rob you of your opportunity to do a 1031 exchange, and you may have to pay taxes. Now, I also talked to a client not too long ago who, unfortunately, he and his wife had been going through a divorce for several years. They had a lot of property, a lot of assets. It was taking a long time. And there were also some mental health issues going on. But they had pretty much split 5 years before and had each been filing their burdens and benefits separately on separate tax returns, even though they were still legally married and the property was held, the title said community property. They had been filing all the burdens and benefits separately for 5 years. And they have a very good case to make that they have separate ownership. So in that case, they may be able to do a successful exchange, even though they'll be doing it separately. So it's not always straightforward and simple. You kind of have to look at the whole picture. We get the same situation, the different taxpayer pitfall with LLCs. Very popular way for people to hold title to property these days. The LLC has been a great corporate entity tool for a lot of businesses, and particularly people who own real estate and want to limit their exposure. So the problem comes in when you've held a property as an LLC. So we have taxpayer one, which is Main Street LLC, and Tom, Sue, and Mary are members of that LLC. They've decided that they want to dissolve the corporation, sell the property, and go their separate ways. And one or two of them, or maybe even all three of them, want to do separate exchanges and take their proceeds and buy another property and use an exchange. Well, the problem is that Main Street LLC is one taxpayer, and Tom Smith is another taxpayer, and Sue Jones is another taxpayer, and Mary Lee is another taxpayer. So let's say our client is Tom Smith. The seller of the relinquished property is Main Street LLC, and the buyer of the replacement property is Tom Smith. So there's no exchange to be done. There's two taxpayers, which means Main Street LLC will have to pay their taxes. Now, there's a couple of ways you can actually avoid this pitfall. One is planning ahead. So if you know you're going to dissolve your LLC in 2019, one of the things that you can do is drop down the ownership of the property to separate tenant in common interest for Tom, Sue, and Mary. Season that interest for the required 2 years, then do the exchange and go your separate ways, because each party is a separate owner and each party will be doing their separate exchange after the dissolution of the LLC. Unfortunately, we usually don't find out about this until the property is already listed or in escrow, and of course they don't want to wait 2 years to do that sort of thing. The other option is keep the LLC intact, do the exchange. So Main Street LLC owns this building, and they know they want to dissolve the LLC and move on. So what you do is Main Street LLC will buy 3 replacement properties and season those as their own ownership, and then after 2 years, drop them down, immediately dissolve the LLC, and the individual owners can do anything they want with that property. They can put it in another LLC, whatever. But the long story short with LLCs is you're going to have to do some planning, either on the front end or the back end. So if the property's already under contract, it's already being sold, the best thing to do is, if you even have to amend your operating agreement, whatever, keep the LLC intact, buy replacement properties for the members, season them, and then distribute them according to your operating agreement in 2 years after the exchange. All right, we have a question up here I just saw. Can you 1031 exchange a second home into a new second home in another state? Okay, this was part of the property qualifications pitfall. And a second home is not exchangeable. And we'll go over that, I believe in just a minute, we'll go over that. That's one of our pitfalls. So this particular pitfall is taxable boot. Remember, we talked about boot being whatever comes out of the sale that doesn't go into the exchange, and it becomes taxable. What people don't realize that involves is things like cash out to the seller. So if you want to do a partial exchange, so you sell your investment property for $900,000 and you say, I need to pay off some debts, whatever, I'm going to hold $100,000 back. So I'm only going to buy a replacement property that's worth, or I'm going to meet my reinvestment requirement of $900,000, but I'm going to keep $100,000 back. So I'm going to replace it with debt on the new property. The problem with that is the $100,000 that you take out will be taxable. And when you're talking about capital gains tax, that's a question that people have that's widely misunderstood. Capital gains is not 15%. It wouldn't be bad if it were 15%. Then you'd pay $15,000 taxes and you take your $85,000 and pay off your debts. However, that is only part of the package. There are 3 different federal taxes that have to be paid, and there is also California state tax. So you're looking at 15% tax only if your total income for the year, including your capital gain, is less than $400,000, which in the year you sell a property probably is going to be more than that. So you're looking at 20%. For income over $400,000, your capital gains tax is 20%, plus a depreciation recapture. All of that wonderful depreciation that you've been writing off on your tax return ever since you've had the property and taking as a loss, now that you're selling the property, Uncle Sam says, oh, I want that back. So depreciation is recaptured at 25%. Then there's a 3.8% Medicare tax. And then we have California state tax, which again is it's a scaled tax rate based on your income, and most likely at this amount, at a $900,000 sale, you're going to be looking at 11.3%. So all of that put together is going to put you at about 40% tax rate. So that $100,000 that you want to keep out of your sale to pay off some debts is going to be taxed at 40%. So you're really only going to get $60,000 out of that. The long story short is if you can get that money anyplace else, it'll be cheaper. If you can get a personal loan, if you can get it from a relative, even, a credit line, it'll be cheaper than keeping it out of your exchange. So keep that in mind when you're thinking of keeping cash out of an exchange. It's very expensive money, and you can probably get it cheaper somewhere else. The next example is in your sale. In your purchase contract, the buyer has requested credits. Maybe there's deferred maintenance that they want a credit for. Maybe there's some permits that need to be done for some improvements, and they've negotiated for the seller to pay for those. Any credit to the buyer, any cash credit to the buyer is going to be taxable boots. So again, on top of that $50,000 credit to the buyer, you're also going to be paying about $20,000 in taxes. So those are very expensive credits. If you can, and this is important to know when you negotiate the contract with the buyer rather than at the end of escrow when you're ready to close, is try to negotiate a lower purchase price rather than a credit to the buyer. There's no problem with a lower purchase price in the exchange, and it's not something that'll be taxable because your reinvestment requirement is based on your net sales price. So if you drop the sales price from $900,000, which is what we have here, to $850,000, the buyer can take care of his own stuff and you don't have to pay taxes on it. So it'll save you money in the end. The last situation is a partial exchange, which is a partial exchange because the reinvestment requirement is short. So you sold for a net sales price of $900,000, but your purchase was only $700,000. This results in $200,000 of taxable boots. Again, you're going to pay about 40% taxes on that, which in this case translates to $80,000. It's very expensive. If you can, some people have financing issues or reasons why they can't buy at the same value that they sold for. But again, if you can get a private loan or, if you have credit problems and you can't get a traditional loan or you need a private loan or anywhere else that you can get that money so that you can meet that reinvestment requirement, it'll be worth it in the long run. So these are things that might require a little forward planning on the exchanger's part to make sure they have these systems in place when they do the exchange, but it will definitely be worth it in the end and will save them money on taxes. Seller financing is a pitfall that a lot of people get into because people who have a lot of liquid funds might think that it's a good opportunity to make some extra money by extending a note to the buyer. So let's say you have a $900,000 property and you get an offer from a buyer, but they say, we'd like you to take back a $300,000 note. And in most cases, the seller would think that's a good opportunity. I can make some good interest for a short-term loan. It's a way to make additional cash on the sale. However, in an exchange, that becomes boot. Remember, any cash out that doesn't go into the exchange is going to be taxable as boot. So if you exclude it from the exchange, you're going to wind up paying about 40% tax on that. In the case of a $300,000 note, that's about $120,000. So all of a sudden, that's not such a good opportunity to make money anymore, is it? So unless you're charging that buyer 40% interest, you're going to lose money. So that may not be something you want to do. Now, if you can make the loan, if you can make that note to the buyer and include the note in the exchange, it may be you may still be able to defer the taxes on it. So what that looks like is you have to assign the note to Asset Exchange Company, your accommodator. And there's a couple of things that can happen with that note. So in other words, the buyer, when they sign on for that note, they have to sign on with Asset Exchange Company, not with you, the seller. The note can be used toward the replacement property. So what that means is it's allowable to use the note as consideration. That $300,000, we can take that right out of your exchange account and put it into escrow on the replacement property. That's allowable according to the Internal Revenue Code. However, it's not really practical. We almost never see this happening because it's really difficult to find a seller of your replacement property who's going to take a note from a third party that they don't know. So even though this is allowable, it's not really done very often. Most likely, the seller is going to have to, rather than assigning the note into the exchange, they're going to just have to use their own cash. So if they're going to be able to put in $300,000 cash from their own funds into the exchange account, then, and they can get that money any way they want. They can sell another property, they can sell the note on the secondary market and put that into the exchange account, or maybe the buyer can pay the note off early and the funds can be used to pay off the note and will be towards the replacement property. And that may be something the buyer just needs to sell their property and they need a note until they can do that. A bridge loan, it may work out in that way, but the thing is you need to have a plan in place and you need, as the exchanger, to be prepared to put your own money into the exchange because, again, you don't want to wind up paying taxes on that note. Now, the second home question. A second home is one of those odd ducks because we know that as far as taxes are concerned, with a primary residence, we can use a homeowner's exemption, right? So if you live in your home for at least 2 years of the last 5, you can sell your home and you can have a certain amount of your capital gain exempted from taxation. It's $250,000 for a single taxpayer and it's $500,000 for a married couple. And that works for most people, so they don't have to pay taxes when they sell their primary residence. However, you can also do a 1031 exchange on a rental property that's non-owner occupied, and you use it as a business or investment property, and when you sell it, you can defer your taxes with a 1031 exchange, right? But what about a second home? What about people who have a house in LA and a house in Vegas, or a house in LA and a house in Big Bear? What's available for their second home? Well, nothing. If it's just a second home, whether it's in this state or another state, when you sell it, you have to pay taxes on it. You don't have anything available to you. Now, if you have a second home in another city or another state and you want to be able to not pay taxes when you sell it, you may be able to 1031 exchange it as a vacation rental. And this is completely allowable, and we're seeing it a lot these days with things like Airbnb and VRBO rentals. There are some requirements to make it qualify as a vacation rental. So again, you have a seasoning period, 2 years prior to the sale. It must have been rented out for a minimum of 14 days for each of the 2 years prior to the sale. You can rent it out as much as you want or as little as 14 days per year to make it qualify as a vacation rental. Now, there's also another requirement. It is a limitation on how much the owner can use it. And that limitation is the greater of either 14 days a year or 10% of the rental days. So you have a cute little cabin like this in Big Bear that you rent out 300 days a year. Unlikely. That'd probably be more likely in Vegas. But let's just say for argument's sake that you rent out this cabin through VRBO or some other service 300 days a year. That means as an owner, you can use it a maximum of 30 days a year. Does that make sense? So 10%, that's the limitation. No more than 14 days or 10% of the rental usage, whichever is greater. And this is for the 2 years prior to the sale. So I think I answered that question. And we have another question. Can a 1031 exchange be done on a primary residence if the gains are used to buy an investment property? And that's from my buddy Donovan. Hi, Donovan. And no, that is not allowable in an exchange. Neither the relinquished property nor the replacement property can be a primary residence. Unfortunately, a 1031 exchange is only for business and investment properties. So what that means is if you're trying to sell your home and buy an investment property, and unfortunately, if you have more gains than what your homeowner's exemption allows, you'll have to pay taxes on that. Now, there is another option. If you know you're going to sell your primary residence and you know you're going to have more than, say, $500,000 of gain in the case of a married couple, which is quite common here in Los Angeles. Maybe you bought a home in maybe 2005 in someplace like Encino, and you bought it for $650,000 or whatever. And today it's worth $2.5 million. And you're going to sell it, but of course your homeowner's exemption isn't going to come close to covering all of the gain that you're realizing on that sale. What you can do, and again, it takes forward planning, is 2 years prior to when you know you're going to sell it, make it into a rental property. And that way, it will have been a rental for the past 2 years and therefore qualify for a 1031 exchange. Now, you can still use your homeowner's exemption on the part of the ownership where it was a primary residence. So you can still use your homeowner's exemption. And then on the gain that's left over, you can do a 1031 exchange. So you can use this to completely eliminate your tax bill on that property. Now, the kicker on that is, of course, you will have to replace it with another investment property, right? So if you make it a rental for the last 2 years before you sell it, and you want to do a 1031 exchange to avoid all of that taxable gain, you'll have to buy a replacement property that is for business or investment. And a lot of people don't want to do that. They say, I'm not a landlord, I don't want to buy another investment property, especially not for $1.5 million, which would be quite an investment on a rental property. So that may be a problem in that exchange, and they may not want to do it. And I talked to a gentleman who decided he would rather pay his taxes. Now, there are some other replacement property options, and if this is a case, this happens a lot of times also with older people who have had a building for a long time and have had some long-time ownership issues, and they want to get out of it, but they don't want to be landlords anymore. So they don't want to pay taxes, but they don't want to be landlords anymore. And what they can do is get into some alternate replacement options, like we have something called DSTs or triple net leases, properties where you can get mailbox cash flow. So just because someone doesn't want to be a landlord anymore doesn't mean they can't do a 1031 exchange. And so let me know if you have someone who is in that situation, and we can talk a little more after the workshop. Foreign sellers. This is a situation where you may wind up paying a tax deposit on your sale if you don't plan ahead and do the right paperwork. So if you haven't heard of it, there's something called FIRPTA, which stands for Foreign Investment in Real Property Tax Act. And what this basically is Uncle Sam doesn't want someone who's a non-U.S. person and owns property in the United States to sell that property and make a large capital gain and then go back to their home country and not pay taxes here in the United States. So it's basically a withholding requirement. Just like if you've had a job with a paycheck and they take money out of your paycheck as a deposit against the taxes that you may owe on your income at the end of the year, that's exactly what this is. So when someone who is a non-U.S. person sells a United States property, the buyer of that property actually has a requirement to withhold 15% of the sales price and deposit it with the IRS on behalf of the seller. Now, of course, the buyer really doesn't do this. It's all done through escrow, but as it's written, it's a requirement of the buyer. So 15% of the sales price will be withheld and deposited with the IRS on the sale of real estate, unless one of two things happens. So normally when we have a real estate transaction and someone is a U.S. person, we fill out a buyer's affidavit. And what that buyer's affidavit does is it certifies that I'm a U.S. person, I have a U.S. taxpayer ID number, I'm going to pay taxes in the U.S., so you don't need to withhold this money. However, what happens if someone's a foreign seller? If someone is not a U.S. person and they cannot execute the buyer's affidavit stating they're a U.S. person, what do? Well, there's also something called a withholding certificate that is for a non-U.S. person. And you get that by filling out this form right here, the 8288, which is the application for a withholding certificate. And on this form, you have to fill out a number of items. You have to put a tax ID number on it, which means you have to get a tax ID number, which can take a little bit of time. Actually, you can get them online now, so it doesn't take too long for that. But you also have to be in escrow when you fill out this form because it asks you about the property, it asks you about the buyer, different details about the sale that you would only know once you're under contract. And so you get this form in, you send it to the IRS, and it can take 8 to 10 weeks to get back your withholding certificate. So you want to do this in a timely manner. As soon as you know you have a deal, send this into the IRS. And then you get back a withholding certificate that you present to escrow instead of the buyer's affidavit. And what that withholding certificate says is that I have notified the IRS that I'm doing an exchange. I will not owe any taxes, and so you don't have to withhold any deposit for those taxes that I won't be paying. And escrow then does not withhold the money. Now, if you don't get the withholding certificate back in time, you can submit the application, and most escrow officers will take that in lieu of the withholding certificate. And if you don't get any of that done, and they do wind up withholding taxes, then what happens? Well, it's not the end of the world. It just means that your foreign seller is going to have to file a U.S. tax return, just like we all do, and wait for a refund. If it's a significant amount of money, of course, they may not want to do that. Let's say it's a $10 million sale, so you're having $1.5 million withheld. That's a lot of money to be missing for the time it might take you to get a refund. So try to do this, get this done. Again, it's a little bit of forward planning. Know what you need to do before you have to do it so you can get yourself set up, and as soon as you get under contract, you can apply for this withholding certificate and not have to pay taxes. Hidden gain. This is one of our most important pitfalls because people have a misunderstanding of what gain is. It's very simply, on the simplest explanation, it's the difference between what you have in the property and what you're getting out of it. So remember when we were talking about the primary residence in Encino that the owner bought for $650,000 in 2005, and they're selling, let's say they're selling it for $2,650,000 in 2017. They've got $2 million of gain there's a few little adjustments that you make, but for the most part, it's the difference between the original purchase price and the market value today. And more specifically, when we're calculating gain, we look at the net sales price, and from that we subtract the adjusted basis. And we'll go over kind of the adjustments to those things. Well, let's go back to that first of all. The net sales price is going to be your sales price minus your closing costs, your non-recurring closing costs. So your broker fees, escrow, title, your exchange fees, all of those things come off the sales price to give you a net sales price. And then your adjusted basis is going to be what you originally paid for the property minus your depreciation, right? That comes off your basis every year, and you see that when you file your taxes. And then any capital improvements you've put into it would add. So net sales price minus adjusted basis. But the common misconception about gain is that it has something to do with your equity in property. So a lot of people, we have a situation here where we have the same $900,000 sale. And let's say it was purchased 30 years ago for $300,000. And it was leveraged a few years ago with a $500,000 loan against the property. So the cash out at sale is only going to be $400,000. And a lot of times people think that that's their capital gain because they don't think they're going to be taxed on the debt. They don't see that as actually owning. It's almost like they see that debt as and it's a lien on the property, but it's an encumbrance, but you still own 100% of that property. So the cash out at sale is not the same as the gain. The gain is, again, your net sales price today minus what you originally paid. So the taxable gain on this property would be roughly $600,000. Now, what if you're even leveraged more? What if you're upside down? Do you know it's possible to have to bring cash to the closing table and still have a capital gain? And people, unfortunately, a lot of people are really just absolutely devastated when they find this out, because you can, let's say, again, have this property that you bought 30 years ago, and when the market was really high, when the market was really hot, let's say 2004, 2005, you leveraged it a lot. You leveraged it for $1 million. Maybe you wanted to buy another property. Who knows what you want to do with money. But anyway, you leveraged it for $1 million. So you're actually bringing cash to the closing table. You're upside down by $100,000. Guess what? You still have that same $600,000 capital gain that's taxable. It doesn't matter what loans you have on the property. So keep that in mind, again, when you're planning. Which leads us into our next slide. The biggest problem and pitfall that exchangers experience is, drumroll please, not planning ahead. When you're doing an exchange or you're planning to do an exchange, it's really important to think about it ahead of time. People get into problems and they find themselves painted into corners with paying taxes and not having things set up to their advantage because they didn't plan ahead. That's the most important thing that you can do to make sure that your exchange is successful. And if you're planning on doing an exchange in 2018, there's a few things that I'd like you to know that you need to know. One is know how to calculate your gain. So we went over that earlier, right? You want to know what your adjusted basis is. And if you don't know what that is, your CPA or your accountant can help you figure that out. And you also need to know what your net sales price is going to be roughly. Know what your property is worth and know what your closing costs are going to be. Also very important to know who's on title. It's amazing how many people think they know who's on title of their property, and when we actually pull the title report, we find out that it's someone else, or it's an entity, it's a corporate entity, or they don't own the property the way they thought they owned the property. So it's not only important to know who's on title, but how they're on title. And that's why one of the first things, well, it is the first thing we do, is we get a preliminary title report before we actually start the exchange to make sure we know who the exchanger is. Know what you want to buy. There's that 45-day requirement for identifying your replacement property. And a lot of people get really nervous about this, but it's not really something you need to get nervous about. It's something you need to plan for. And know that you can start looking for replacement properties while your sale is in escrow. You can even enter into an escrow on your purchase property while you're in escrow on the sale. They can be in escrow at the same time. You just want to make sure that you close on your sale before you close on your purchase, but it can be the next day if you want. So know what you want to buy. Have done some forward planning, run some numbers. At least know, do you want to buy an office building? Do you want to buy a residential rental? Do you have an area in mind? Start looking at the numbers, work with your agent, you look at what's available, and get a good, firm idea. And that's one of the most important ways that you can plan ahead. And of course, know your exchange accommodator. We at Asset Exchange Company, of course, hope that you will use us for your exchange. We are the experts, and we will make sure that we guide you in the right direction and give you the information that you need to have a successful exchange. And that being said, once we get started, What we do is after we get that call from you and you tell us you're in escrow and give us your escrow officer's contact information, we work with him or her to draw up your exchange paperwork, and it's based on your purchase contract and your title report. Those are the two really important documents that we need from escrow to be able to get your paperwork together and make sure it's all in compliance with the Internal Revenue Code and that your exchange is all kosher and completely in compliance. Then once you close on the sale, we hold your exchange funds in an FDIC insured money market account. So your funds are safe. We have a list of several well-known business banks in California that we use, and we have that list available if anyone is interested in seeing it. So your money is safe, and as I mentioned, we also are bonded and insured ourselves. When the exchange is completed, we make sure that your funds go into escrow for the purchase, and if there's anything left over, any cash out, any of that boot that you don't want, but sometimes it can't be avoided, then we distribute those funds at the close of the exchange as well. And then down the road after the exchange, we are available for audit support. As I mentioned, we are the only exchange accommodator that has a licensed tax attorney on staff in the office overseeing our exchanges every day from 9 to 5, and he also provides audit support in the case that it is needed, and we will be around and there for you should that be the case. That is our Problems and Pitfalls webinar. So I hope that I have answered most of the questions. If I haven't, please feel free to call me or email me after the workshop. I love to hear from people. This is my office, my cell, and my email address. I'm available on any of those contact numbers. And please give me a ring. And we hope to work with you in the future. And we hope you have a happy holiday. And we'll see you in 2018. Thanks so much for spending your time. Bye-bye.